A major tech company abruptly axes 10% of its workforce. A family watches their monthly mortgage quote jump by $600 in a single afternoon. The stock market wipes out weeks of gains, while an emerging market currency loses a tenth of its value in a day. These crises are the calculated output of a single boardroom. They were triggered when a small committee adjusted a specific percentage point by a fraction of a percent. In the United States, that committee is the Federal Open Market Committee. They meet 8 times a year to set the federal funds rate, the baseline cost at which banks lend each other money overnight. While it appears central banks govern prices, corporate growth, or wages, their actual influence is narrower. They control the base cost of money itself. This mechanism isn't unique to the US. The European Central Bank, the Bank of England, and the Bank of Japan all use their own equivalent policy rates to steer their respective economies. Because every financial decision is ultimately a comparison against the cost of borrowing, moving this one number forces the global economy to recalculate. That signal travels through a network of invisible pipes known as the transmission mechanism. The first pipe is direct borrowing. When a central bank raises its overnight rate, commercial banks face immediate increases in their own funding costs. To maintain their margins, they pass those costs directly to their customers. Within days, the interest rates on mortgages, auto loans, and credit card APRs begin to climb. This immediate price hike is designed to cool the economy by making big-ticket credit-financed purchases less attractive to the average household. The second pipe targets asset prices. Interest rates act like gravity on financial markets, maintaining a strict inverse relationship with stocks and bonds. Investors value a company by discounting its expected future profits back to the present day. When interest rates rise, those future profits are mathematically worth less in the current moment, causing stock prices to adjust downward. This creates a wealth effect. When portfolios and home values dip, people feel poorer and proactively reduce their spending, even if they aren't currently carrying any debt. By choking off credit and lowering the perceived value of assets, these first 2 pipes act as a primary braking system for an overheating economy. The third pipe reaches the labor market. Businesses evaluate every new factory, product line, and job opening against the cost of the debt required to fund them. When capital becomes expensive, projects that were profitable at 4% become losses at 7%. Companies respond by freezing hiring and eventually laying off workers to protect their margins and prevent a wage price spiral. The fourth pipe is global. Because the US dollar is the world's reserve currency, higher U.S. rates suck capital out of foreign markets as investors chase safer, higher-yielding American assets. As capital leaves, foreign currencies weaken. This forces other nations to hike their own interest rates defensively just to protect their currency's value, regardless of whether their domestic economy actually needs a slowdown. This entire process operates with long and variable lags. Because many homeowners have fixed-rate mortgages and businesses plan budgets years in advance, it typically takes 6 to 18 months for a rate change to reach its full effect. This delay means central bankers are essentially steering a massive ship while only being able to see where they were a year ago. It is why hiking cycles so frequently result in overcorrection and recession. This economic pressure is applied for one reason: to drain excess demand from the system and achieve a soft landing, cooling inflation without triggering a collapse. The limits of this strategy are being tested in July 2026. Following Jerome Powell's departure, new Fed Chair Kevin Warsh has taken over during a period of high geopolitical instability. After 2 years of cutting rates, a sudden conflict in the Middle East has spiked oil prices back above $100 a barrel, reigniting inflation fears almost overnight. Interest rates are a tool for managing demand. While they can convince a consumer to cancel a car loan, they cannot drill more oil, fix a broken shipping lane, or stop a war. This supply shock leaves central banks with an impossible choice. In Europe, the ECB is weighing rate hikes to fight energy-driven inflation, even though their domestic economies are already showing signs of significant weakness. The cost of money remains the most powerful lever in the global economy. But pulling that lever to stop inflation is a mechanical act that reverberates through every link in the transmission chain, ensuring that the cost of stability is always paid by someone, somewhere.